As you know, we are beginning topic 14, and this happens to be the final topic of the year. And we are coming full circle. If you remember way back to accounting 1, way back in September, we began with very simple financial statements, and we are looking at a much more complicated income statement and balance sheet. The two statements on the screen are very similar to the ones that I used for the demonstration video at the beginning of topic 13. And also, you may recognize the information from yesterday's problem. And I want to review that just very quickly. If we look at the highlighted sections, these statements now, unlike the ones way back at the beginning of the school year, also show contra accounts. So on the balance sheet over here, for example, we have accounts receivable less the allowance for uncollectible accounts. That's our estimate. So we expect that we will receive about 48,300 in accounts receivable because we expect some bad debts, unfortunately. Under plant assets, the long-term assets, we have office machines and we have a truck, and both of them depreciate. They tend to wear out, and we need to show that so that we have a more accurate value stated on the balance sheet. Office machines we bought at one point in the past for $1,200. It has depreciated by this time $500 as shown in the ledger. So the actual value now of the office machines, the more accurate value is $700. Truck originally purchased for $60,000, and it has depreciated by an amount that we calculated to be $7,500. Subtract that from $60,000. The net value of our truck now is $52,500. So those are nothing new. Those are now shown on the balance sheet as contra accounts to make accounts receivable and a couple plant assets more accurate. Over on the income statement, recently we talked about not only sales, but we also looked at what reduces the total sales from 155,000 to net sales of a bit less. We have to subtract discounts. So we give customers discounts if they pay early, perhaps, and sometimes things are returned to us and we give the money back, or we give credit to the customer, or we allow them to pay a lesser price. And that adds up to $1,550. These two are negative numbers subtracted from the 155,000. The two negative numbers add up to a bit more than 9,000, and then that gives us net sales when we subtract. So we've looked at that in the past. We've also recently looked at how we reduce purchases. And I want to spend some more time with this today, but purchases basically is the account shown when we buy merchandise, when we buy things that we will resell. So we bought purchases in the month of May. This ABC bookstore has an accounting period of 1 month, we will assume, and during that month we bought merchandise valued at $40,870, and we perhaps had a discount given to us, and perhaps we returned some things, and perhaps we had some allowances given to us. Both of these are negative numbers subtracted from the $40,870, giving us net purchases of $38,435. Again, this represents merchandise that we bought to resell. Now, let's take a look at a little bit more on the income statement. First of all, let me get rid of our highlights here that we don't need at this point. We're not going to be looking at the balance sheet, and we're not going to be looking at the revenue section of the income statement, but we will be looking at this entire section, cost of goods sold. So we want to look at the section highlighted in yellow. If you remember a few topics ago, we talked about things like first in, first out, FIFO. We talked about last in, first out, LIFO. Average cost, when we calculated the cost of goods sold. This bookstore does it a bit differently. This is another method that we will be looking at, and it incorporates not only purchases, but it also incorporates this account called merchandise inventory. Now, we have had that. I've shown this to you on ledgers and various problems, but we haven't really used it much. Now we're going to explain why it's there and how it's used. This is stated merchandise inventory, May 1 of 2020. This is the beginning of the accounting period, $67,000. If we would go back to the ledger, let's look at the tab at the bottom. This is a partial general ledger. And if we look at this account that I have right in the middle of your screen, merchandise inventory is an asset account, and it is dated May 1, 2020. It has a debit balance of $67,000. We also have this account over here in the section we call cost of merchandise, called purchases. And as of the end of the accounting period, we purchased some merchandise totaling $40,870. Now we want to look at the interaction and the relationship between the purchases account and the merchandise inventory account. They sound like the same thing. And in accounting, we will want them separated, as we'll see in just a moment. So this number, $67,000, represents how much inventory we had at the beginning of May, at the beginning of the accounting period. And it's shown on the income statement under cost of goods sold. Merchandise inventory, $67,000 at the beginning. There's some calculations that we do with this now, and eventually there would be an adjusting entry that we'll talk about perhaps a little later, but we're not quite ready for that yet. But we want to look at where all this ends up on the income statement. The owners will want to know how much merchandise inventory we had at the beginning of the accounting period, so that's shown. We also want to look at purchases. Now, there's a couple deductions from purchases, as we've learned. When we buy merchandise for $40,870, we sometimes get a discount, and we subtract that. We sometimes return things, or we get an allowance. We subtract those as well. So when we subtract those two numbers from the purchases amount, we will get what we call net purchases of $38,435. We've done that actually a number of times with journalizing and posting. So we bought merchandise, and we have a couple deductions from that based on discounts and returns and allowances, giving us net purchases. So we show this on the income statement. Now, a new part here that will be shown on this statement, we will now we will add net purchases plus what we had at the beginning. I just showed you this account called merchandise inventory in the ledger. At the beginning of the accounting period, we had $67,000 worth of inventory to sell. We now have calculated net purchases. We bought some more merchandise. Net purchases, $38,435. Add those two together, we have something called total cost of goods available for sale. So we have that much available for sale. That's what it cost us for all that merchandise. Now, we didn't sell it all. We never do. We always have some left over, we would expect, at the end of the accounting period. So the next line shows something that we have not talked about yet. Many businesses do what's called taking inventory, and you may have heard of that term before. Sometimes a store, a business will actually shut down for a period of time where they literally count the merchandise that they have on the shelves. Now, it's not that simple, actually. It's much more automated in this day and age. We're not going to get into how that automation works, but basically, by an automatic method or methods, the company will determine what inventory is available at the end of the accounting period. Merchandise that is unsold. So we've just calculated the amount available for sale, And you may need to go back again and walk through this with this video to see how this 105,435 is calculated. Then when we take inventory, we determine that we have still on our shelves 64,310. Now a subtraction problem. We subtract 64,310, the stuff that we have still on the shelves, subtract it from what we had available. That gives us the cost of goods sold. These two numbers subtracted will give 41,125. That's the cost of the goods that we actually sold. Then, one more little calculation here. We will subtract, and we've done this part before, we will subtract the cost of goods sold from the net sales. Those two numbers are subtracted, and we get gross profit of 104,762. So that's the middle part now of the income statement. At the very beginning, we simply subtracted all the expenses from all the sales, and we got net income. A bit more complicated now. The cost of goods sold is a big factor that needs to be included on the income statement. Finally, to get net income, we will take the gross profit, subtract from it the total of all the expenses that we have, and when we do that subtraction problem, we end up with a net income 35,571 in this case. One more thing I want to show you here before we leave this. This number, back up here in cost of goods sold, the merchandise inventory at the end of the accounting period, in this case May 31, will end up over here on the balance sheet. You see on the balance sheet we show merchandise inventory, and this is dated May 31, so at the end of the accounting period, we show merchandise inventory of 64,310. That's an asset. We don't show purchases because it's included in this computation we did over here with cost of goods sold. So this number that we calculated and put on the income statement showing ending inventory will eventually end up over here when we calculate the balance sheet. So somehow we have to do an adjusting entry so that back in the general ledger, this account should show the ending merchandise inventory, not the beginning. So we have an adjusting entry that we may or may not get to, but that needs to be done to verify that our ledger accounts are up to date and accurate. The important part right now for you is the part highlighted in yellow on the income statement, so spend some time going back over that because we need to know the relationship particularly between the merchandise inventory account at the beginning and the merchandise inventory account at the end of the accounting period, and how we get from the 67,000 to the 64,000 using purchases and the discounts and the returns and so forth. So review this if you need to, and now let's go back to your course page, and there are some questions based on this video.